All right, now for more on Wall Street and earnings season, Chris Versace joins us. He's Chief Investment Officer for Tematica Research. Welcome back to the show.
Oh, thanks for having me.
So apart from a few dips, the U.S. Stock market has really been on a surge for the first half of 2017. What do you think are the main drivers of this momentum?
Well, I think if we dial it back even to November, December, really since the election, the market has been in almost a euphoric state for what we inside Tematica call the Trump bump. A lot of expectations that things were going to happen. The president was coming in with a strong agenda, going to repeal health care, reform taxes, get infrastructure spending going. And I think that really propped the market up through the first 3 or 4 months of the year. Since then, however, it hasn't been quite as strong. It's trended higher, but not quite at the same vector, the same velocity that we saw really in the first quarter.
And if we could just take a look, we saw that the Dow and the S&P up more than 10% this year, the NASDAQ more than 17% so far this year. So as you mentioned, with this euphoria, with all this exuberance, are the U.S. markets due for a correction? And if so, what do you think might trigger it?
Sure. So, I mean, there's no question that the speed of the economy is, a little slower than people might have thought this time, a year ago. Having said that, though, the stock market valuation, as you pointed out, it's continued to move higher. That means the valuation is relatively stretched to their historical norms. So do we think that we're vulnerable of a potential pullback, not necessarily a crash or correction, but a pullback? We think we are. In the clip that they played coming in, they talked about August and September being 2 of the worst months. Well, what do we have coming up this September, right? We have a few things to be concerned about. One, we'll probably get the unveiling of the Trump tax reform. So the question is, what is that? Does it live up to expectations? Second, we've got the Fed that's going to start unwinding its balance sheet, supposedly. We've never seen anything like that. So, another big unknown. And then third, we have to get through the debt ceiling conversation in what's likely to be a very politically turmoil year. So a lot of uncertainties.
And it's interesting because when we look at some of the uncertainties, so far the U.S. markets, apart from what we saw with the DPRK, seem to be really shrugging off a lot of these risks that we're seeing. Is that smart to have built those in, or could that potentially be risky?
Well, I think you have to understand really what's driving it, right? So, in the beginning of the year, there was all the FANG, Facebook, Amazon, Netflix, Google, and to some extent, Apple. Later in the second, third quarter, thus far, we've seen companies like Boeing. So if you're looking at the Dow, remember, it's only 30 stocks. If we look at the S&P, those FANG stocks have still had a pronounced impact. But from our perspective, again, inside Tematica, we see those companies benefiting from what we call the march towards the connected society. And we don't see a slowdown in that. Outside of that, we look at the destruction that's happening in retail. You mentioned Dick's earlier. We'll see what happens with Walmart. There are pockets of weakness. So as investors, we don't buy the market, right? We buy individual stocks. So we would say that if you recognize the right tailwinds, there is more room to run. If, on the other hand, the companies you're looking at are running into a headwind, you might want to be careful.
Now, that's interesting. We're talking about these individual companies. How much of the momentum that we're seeing is really up to these individual companies as opposed to perhaps looking at the broader health of the American economy?
Well, again, it depends on the index you're looking at. If you go back to the Dow, it's only 30 stocks. So, it's going to be very selective based on which ones are moving and how they're weighted within that index. If we were to dial it back and look at the overall economy, we did 1.4% GDP growth in the first quarter, rebounded to 2.6%. The back half, maybe 2.5%. We'll see how it comes out. Today's retail sales report, a little stronger than expected, so a little positivity. That's offset, though, by some of the manufacturing reports we've been seeing and the slowdown we're seeing truck tonnage and in July, for example, in weekly rail car loadings. So continued mixed bag, if you will, for the domestic economy.
Now, in terms of how it compares to how other global markets are performing, where do the U.S. markets stand?
Now, that is actually a great question because, we said, the U.S. market's up, 10, 11%, Dow, S&P 500 up 17% for the NASDAQ. Take a look at what's going on in Europe. They're up about 17%, but certain markets like Italy are far stronger. Italy's about 24%. If we look at the emerging markets, that's up 24, 25%, and even Mexico is up around 29%. So what are we seeing in those markets? Believe it or not, economic growth is actually a little more vibrant, and I think that's rolling through. We've also got those central bankers there are still embracing a looser monetary policy. Remember, we've seen 3 rate hikes here in the U.S., and the Fed is on course to, again, potentially unwind its balance sheet with a 4th interest rate hike looming towards the end of the year, first quarter of 2018.
So certainly worth taking a global perspective on it to curb the enthusiasm.
Absolutely true. And I would tell you that the way we look at the world from a thematic perspective, the themes that we see here in the U.S. ripple through into Asia. I was just in Singapore, and I have to say, when it comes to cashless consumption, they are light years ahead of where we are in the U.S.
That's certainly another conversation still to be had. Thank you so much, as always, Chris Versace, Chief Investment Officer at Tematica Research.